If you're preparing to sit for the Michigan Life Insurance Producer exam, this video was made for you, and it focuses on one thing: the Michigan-specific material that the state portion of your exam actually tests. The national concepts, how whole life works, what a beneficiary is, how underwriting decides your rate. You're learning those from your main course. We won't repeat them here. What we will do is walk through the Michigan rules, numbers, and deadlines that differ from the national norm, because that's where points are won and lost on test day. Here's how to get the most out of this. Listen all the way through once to see the shape of it. Then come back to the sections with the heaviest numbers and let the repetition do its work. Michigan loves to test specific figures: a grace period, a passing score, a coverage limit. And the exam writers know which ones students confuse. We'll call those out as we go. By the end, you'll have a clear map of what Michigan does its own way, and the confidence to recognize the right answer when a question tries to steer you wrong. Every state has a government body that oversees insurance, and in Michigan, that body is the Department of Insurance and Financial Services, which everyone shortens to DIFS. DIFS licenses producers, approves continuing education, sets fees, and disciplines agents who break the rules. When the exam refers to the director or the department, it means DIFS and the official who runs it. Keep that name in your ear: Department of Insurance and Financial Services. Michigan licenses more than one kind of salesperson, and the distinctions are testable. A producer is the main license. It's what most people mean when they say insurance agent, and it lets you sell, solicit, and negotiate insurance. A solicitor is a narrower role. A solicitor works under and is sponsored by a licensed producer, and the application for a solicitor license has to come with a notice of appointment from that sponsoring producer. Think of the solicitor as licensed to act on behalf of a producer rather than independently. A counselor is different again. A counselor is licensed to give insurance advice for a fee. The quick way to hold these apart: a producer sells, a solicitor sells under a sponsoring producer, and a counselor advises for a fee. Don't confuse the solicitor with the counselor. The exam likes to swap their definitions. To get licensed as a resident producer, you must be at least 18 years old. You complete the required pre-licensing education, you pass the state exam, and you submit to a background check. Michigan does not require fingerprinting for the resident producer license, but you do have to pass that background review, and you must not have committed any of the 9 acts the law lists as grounds for denying or revoking a license, things like fraud, forgery, or misrepresentation. Pre-licensing for the Lifeline is 20 hours. That 20 hours breaks down into 14 hours of life insurance content and 6 hours of ethics and Michigan insurance law. Remember the number 20, and remember it's per line of authority. So a candidate going for life and health together faces 40 hours. A few mechanics that show up on the exam. You apply for the license itself through the National Insurance Producer Registry, the NIPR. The state application fee is $10, plus a $5.60 transaction fee. Being licensed is not the same as being able to write business for a company. Before you can act as an agent for an insurer, that insurer must appoint you, and the appointment is filed electronically within 15 days. If you move here from another state, Michigan grants a non-resident producer license on a reciprocal basis. You qualify if you hold a resident license in good standing in your home state, and that state extends the same courtesy to Michigan residents. Michigan also allows a temporary license, issued without an exam and valid for 90 days, used in limited situations such as servicing the business of a producer who has died or become disabled. And if your license lapses for a reason other than missing continuing education, you can reinstate the very same license without retaking the exam, as long as you do it within 12 months of the lapse. On your exam, that reinstatement window is 12 months. Tie it to the idea that the state gives you a 1-year door back in. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Once you're licensed, Michigan expects you to keep learning, and the requirement is precise. You must complete 24 hours of approved continuing education every 2 years to renew. Of those 24 hours, at least 3 must be in ethics. Say those two numbers together until they stick. 24 total, 3 in ethics. A common exam trap is to offer an answer with the right total but the wrong ethics figure, or the right ethics figure attached to the wrong total, so anchor both. What happens if you miss the deadline? This is the part worth memorizing because it's distinctly Michigan and distinctly testable. If you haven't met your CE by the time your license expires, you get a 90-day grace period to finish it. But that grace period comes with a hard restriction. During those 90 days, you may not solicit or sell new policies, you may not bind coverage, and you may not otherwise act as a producer on new business. You can keep servicing policies you already sold, and you can keep receiving commissions on that existing business, but the new sales door is closed until your CE is current. And if you reach the end of the 90 days still short on hours, the director cancels your license outright, and you'd have to reapply. So picture it as a 90-day window that keeps you connected to your old clients, but locks you out of new sales. Finish your hours, and the lock comes off. One more piece connects to a later section. Selling annuities carries its own one-time training requirement on top of this 24-hour cycle. We'll cover that in detail when we reach annuities, but file it away now. Annuity training is separate from, and additional to, your regular CE. Let's talk about what Michigan law forces every life insurance policy to contain, because a handful of these provisions are tested precisely, and the grace period is the star. Here is the rule. Michigan requires a grace period of 1 month for the payment of every premium after the first year, and the policy may charge interest on the late premium during that month. We'll say that again because the phrasing matters. A 1-month grace period on premiums falling due after the first policy year. During that month, the insurance stays in force. If the insured dies inside the grace month with a premium unpaid, the insurer doesn't deny the claim. It simply subtracts the overdue premium from the death benefit it pays out. Why does the state require this? Because a single missed payment shouldn't cost a family its coverage. People forget, checks get lost, money runs short for a few weeks. The grace period builds in a cushion, so a brief lapse doesn't become a catastrophe. Once you understand that purpose, the rule is easy to keep straight. Now contrast this with what you studied nationally. A lot of national material describes grace periods as a flat 30 or 31 days running from the premium due date. Michigan's required provision is framed as 1 month and is tied to premiums after the first year. If a question gives you a Michigan policy and asks about the grace period, the answer to anchor is 1 month. Picture a scenario. A premium is due on the 10th of the month and isn't paid, and 3 weeks later, the insured dies. Is the death benefit payable? Yes, the policy was still inside its 1-month grace period, so coverage continued, and the insurer just deducts the premium it was owed. Tied to the grace period is a notice rule. Before coverage terminates for non-payment, the insurer generally must send written notice to the policy owner's last known address at least 30 days before termination. That 30-day termination notice does not apply to insurers that collect most of their premium in person. 2 more required provisions deserve a quick word, mainly so you can recognize them, since they follow the national pattern. Michigan life policies become incontestable after they've been in force for 2 years during the insured's lifetime. After 2 years, the insurer can't void the policy for a misstatement in the application. And a misstatement of age doesn't void the policy. Instead, the benefit is adjusted to what the premium paid would have purchased at the correct age. The grace period is the Michigan-flavored item here. Lock in 1 month. Suppose a client buys a policy, takes it home, reads it over the weekend, and decides it isn't what they wanted. Michigan gives them a way out, and it's called the free look period, also known as the right to return. By law, a life insurance policy must display on its front page a notice telling the policy owner that for a period of not less than 10 days after they receive the policy, they may cancel it and get a prompt, full refund of every premium paid, including any policy fee or other charge. To cancel, the owner returns the policy to the insurer or the agent with a written request, and the policy is treated as void from the very beginning, as if it had never been issued. Hold on to the number, 10 days. That's the floor Michigan sets. Some companies voluntarily offer longer, but for exam purposes, the required minimum is a 10-day free look on an individual life policy. The same 10-day right applies to annuity contracts, which carry their own front-page free look notice. There's one extension worth knowing because it pairs a number with a condition. When a universal life policy is involved and the company delivers the policy sooner than 5 days after giving the buyer the required statement of policy information, the free look period stretches to 15 days. So the everyday answer is 10 days. The universal life with quick delivery answer is 15. On your exam, if a question sets up a universal life policy delivered before the buyer had a fair chance to compare, think 15 days. Otherwise, the free look you anchor is 10. Variable life insurance deserves its own stop because Michigan regulates it in real detail and because it behaves differently from an ordinary policy. In a variable life policy, the cash value is invested in a separate account, a pool of investments kept separate from the insurer's general funds, and the policy's value rises and falls with how those investments perform. Because the buyer takes on investment risk, variable products are also securities, so selling them requires the proper securities registration in addition to your Michigan Life license. Keep that dual license idea in mind. It's a favorite test point. Michigan's variable life rules set several specific terms. A scheduled premium variable life policy must give a grace period of not less than 31 days from the premium due date. Note that's 31 days here, a different figure from the 1-month grace on ordinary policies, so don't blur them. The policy must allow reinstatement at any time within 2 years from the date of default, provided the cash surrender value hasn't already been paid out. And there's a conversion privilege that's easy to test. During the first 18 months, as long as premiums are paid, the owner may exchange the variable policy for a permanent fixed benefit policy without having to prove insurability again. That 18-month exchange window protects a buyer who decides the investment risk isn't for them. The free look on variable life is its own animal. The owner may return the policy within 45 days of signing the application or within 10 days of receiving the policy, whichever is later. So the variable life free look isn't a flat number. It's the longer of those two measures. There's also a protection if the insurer makes a material change to the investment policy of the separate account. A policyholder who objects can convert to a fixed benefit policy without evidence of insurability. Recap the variable life numbers you must lock in: a 31-day grace period, reinstatement within 2 years, an 18-month exchange to a fixed policy, and a free look that runs 45 days from application or 10 days from delivery, whichever is later. Replacement is when a new life policy is bought and an existing one is, as a result, lapsed, surrendered, or otherwise reduced in value. In plain terms, swapping out an old policy for a new one. Michigan watches replacement closely, because a replacement that isn't in the client's interest can cost them a fresh contestability period, new surrender charges, and higher premiums based on an older age. The state's rules put specific duties on the agent and the insurer. Before the application is completed, the agent has to give the applicant 2 documents: a notice to applicants regarding replacement of life insurance and an information statement. The applicant signs both, and the agent signs the information statement. The agent also has to leave the applicant with a copy of every sales proposal used in the presentation. The point of all this paperwork is consumer protection. It forces the comparison out into the open so the buyer can see what they're giving up. The insurers have duties too. Within 3 business days of receiving the application, or the day the new policy is issued, whichever comes first, The replacing insurer must notify the existing insurer that a replacement is happening and send along a copy of the sales proposal and the completed information statement. That notice gives the existing company a chance to contact its policyholder and make its case to keep the coverage in force, a practice called conservation. An agent who is trying to conserve an existing policy has to submit a copy of their sales proposal to the existing insurer as well, and the replacing insurer keeps these records for at least 3 years. Here's a caution that doubles as a contamination check against your national material. Some states attach an extended right to return period, often 20 or 30 days, specifically to replacement transactions. Michigan's framework is built around the notice and information statement and the 3-business-day notice to the existing insurer, not a special replacement free look number. So if a Michigan question is really about replacement, anchor the notice and information statement duties and the 3-business-day window, not a 20-day return period. Michigan's Uniform Trade Practices Act spells out what a producer may not do, and several of these prohibited practices are reliably tested. The biggest is rebating. Rebating means giving a client something of value that isn't stated in the policy in order to induce the sale. Kicking back part of your commission, paying their first premium for them, throwing in cash, stocks, or any special favor not written into the contract. Michigan prohibits it, and the prohibition runs both directions. The producer can't offer the rebate, and the customer isn't supposed to accept one either. The reasoning is fairness. If one buyer can negotiate a secret discount, identical customers are being treated unequally. And that's exactly what the law is trying to prevent. A narrow exception is worth a sentence, because the exam may use it to bait you. Michigan lets a property and casualty producer give a customer a small piece of merchandise of modest value per year as a goodwill item. That carve-out is for property and casualty, not for life. So if a question dresses up a gift to a life insurance client as an allowable promotion, be suspicious. On the life side, the anti-rebating rule stands. Then there's misrepresentation and a cousin practice called twisting. Misrepresentation is making a false or misleading statement about a policy's terms, benefits, or dividends, including by leaving out a material fact. Twisting is using misrepresentation specifically to convince someone to drop one policy and replace it with another. Both are prohibited. Beyond these, remember that the law lists 9 acts that are grounds for the director to deny, suspend, or revoke a license. Fraud, providing false information on an application, forging another's name, cheating on the licensing exam, and similar misconduct. Violations of the rebating and misrepresentation rules aren't just license problems. They can be charged as a misdemeanor. Picture an agent who tells a client a whole life policy is fully paid up after 10 years when the contract says no such thing, to get them to surrender an existing policy. Has the agent crossed a line? Yes, that's misrepresentation used to drive a replacement, which is twisting, and it puts the license at risk. Annuities get special treatment in Michigan, and this is a high-value section because the state raised the bar in a way the exam now tests. Under Michigan Public Act 266, effective June 29, 2021, a producer who recommends an annuity must act in the best interest of the consumer. That phrase, best interest, is the heart of it. The older rule asked only whether a recommendation was suitable. The best interest standard goes further and requires you to put the consumer's interest ahead of your own financial interest in the sale. In practice, the best interest standard breaks into 4 obligations, and they're worth memorizing as a set. The care obligation: you must have a reasonable basis to believe the annuity effectively addresses the consumer's situation, which means knowing their financial picture, needs, and objectives. The disclosure obligation: you must tell the consumer, in writing, about your role, the products you can offer, and how you're compensated. The conflict of interest obligation: you must identify and avoid or manage conflicts that could steer your recommendation. And the documentation obligation: you must put your recommendation and the reasoning behind it in writing. Care, disclosure, conflict of interest, documentation, 4 obligations. There's a training requirement attached, and it pairs a number with that effective date rule. A producer who becomes licensed on or after June 29, 2021 must complete a one-time 4-hour annuity training course approved by the director before they sell any annuity. Producers who had already completed an earlier annuity course before that date were given a transition path to update their training. Remember the figure, a one-time 4-hour course, and it's separate from your regular 24 hours of CE. Michigan also uses a specific producer disclosure form for annuity sales, the FIS 2367, which documents that disclosure obligation. Because these protections matter most for older buyers, expect exam scenarios involving a senior considering an annuity. The best interest analysis is exactly what those questions are checking. When an insured dies, the beneficiary files a claim, and Michigan law sets expectations for how promptly the insurer has to act, backed by a financial penalty if it drags its feet. This lives in the same Uniform Trade Practices Act, and failing to pay claims on time is itself defined as an unfair trade practice. Two time frames drive the rule. First, within 30 days of receiving a claim, the insurer must specify in writing what it needs as satisfactory proof of loss, unless it just settles the claim within those 30 days. Proof of loss, for a life claim, is essentially the documentation that the insured has died and that the claimant is entitled to the benefit. Second, once the insurer has that satisfactory proof of loss, the clock starts. If it fails to pay on a timely basis, the benefit accrues simple interest at 12% per year, running from a date 60 days after the proof of loss was received. For the beneficiary on a life policy, a first-party claimant, someone directly entitled to benefits under the contract, that 12% penalty interest applies straightforwardly when payment is late. Walk through it. A beneficiary submits complete proof of death, and the insurer sits on the claim for several months without a valid reason. What does Michigan require? The insurer owes the death benefit plus 12% simple interest, counted from 60 days after it received that proof of loss. The number to lock in is 12%, and the trigger is 60 days after satisfactory proof of loss. The purpose here is plain. The law penalizes insurers for stalling on legitimate claims, so families aren't left waiting on money they're clearly owed. What happens if a life insurance company itself fails, goes insolvent, and can't pay what it promised? Michigan, like every state, has a safety net for that, and it's called the Michigan Life and Health Insurance Guaranty Association, often shortened to MLHIGA. It's a nonprofit association of the life and health insurers licensed in the state, and when a member company becomes insolvent, the association steps in, within limits, to protect Michigan policyholders by assessing the surviving member companies to cover claims. The coverage limits are precise, and they're prime exam material. For any one life, regardless of how many policies that person holds with the same insolvent company, the association covers up to $300,000 in life insurance death benefits, but no more than $100,000 of that in net cash surrender value. For annuities, the protection is up to $250,000 in present value of annuity benefits. Say the life numbers again, because they're the ones tested most. $300,000 in death benefits, $100,000 in cash surrender value per life per company. The phrase per one life matters, and there's a classic illustration. Suppose someone owns 3 annuities, each worth $100,000, all with the same annuitant and all from the same insurer, and that company is liquidated. The total protected is not $300,000, it's capped at $250,000, because that's the maximum the association covers for all annuities from a single insurer on one life. The limits aggregate, they don't stack per policy. One more principle the association itself stresses. This protection is a backstop, not a substitute for choosing a financially sound, well-managed company in the first place. Anchor the life figures, $300,000 and $100,000, and the $250,000 annuity cap. And remember, they apply per life, per insurer. The state portion of your exam is delivered by PSI, the testing vendor DIFS uses, and knowing the format ahead of time settles the nerves. The Michigan Life Producer exam is 100 scored questions. You're given 120 minutes, that's 2 hours, and you need a score of 72% to pass. Commit that to memory. 100 questions, 72%, 2 hours. A handful of additional unscored experimental questions, usually 5 to 10, may be mixed in and don't count toward your result, so don't be thrown if the exam feels a couple of questions longer than expected. The exam fee is $41, and it's non-refundable and non-transferable, so schedule only when you're ready. You take the exam in person at a PSI test center. Michigan has sites including Dearborn, the Holt Center near Lansing, Southfield, Grand Rapids, Gaylord, and Marquette. Plan to arrive 30 minutes early for check-in and bring 2 forms of valid, unexpired identification. One of them a primary photo ID such as a driver's license, state ID, or passport, the names matching exactly what you registered under. If you don't bring proper ID, you forfeit the fee and don't test. A few timing rules round this out. Your prelicensing education certificate is valid for 12 months, and a passing exam result is also valid for 12 months, so don't let either sit too long before completing the next step. You apply for the license itself through the NIPR. If you fail, you can't retest the same day, but you can schedule again and sit as soon as the next day once results process, and each retake is another $41. To cancel or reschedule without losing your fee, you generally need to notify PSI at least 2 days before your appointment. And one licensing quirk to keep straight. While life producers complete 20 hours of prelicensing, the standalone variable life and annuities producer license requires passing the exam without that prelicensing coursework. On your exam, the figures most likely to be tested from this section are the 100 questions, the 72% passing score, the 120 minutes, and the $41 fee. You've now covered what makes Michigan its own animal, so let's lock in the numbers you must carry into the exam room. The grace period on a Michigan life policy is 1 month, on premiums after the first year. The free look is 10 days, stretching to 15 on a quickly delivered universal life policy, and running 45 days from application or 10 from delivery on variable life. Continuing education is 24 hours every 2 years with 3 in ethics and a 90-day grace period that bars new sales. Selling annuities means meeting the best interest standard and finishing a one-time 4-hour training course. A late life claim earns 12% interest starting 60 days after proof of loss. The Guaranty Association protects $300,000 in death benefits and $100,000 in cash value per life, with a $250,000 cap on annuities, and the exam itself is 100 questions, 72% to pass, in 120 minutes for $41. Mix any of these up, and you'll lose points you didn't need to lose, so drill them until they're automatic. Here's the encouraging truth as you head into your final review. The Michigan portion is a finite, knowable list, and you've just been through it. Master these distinctions, and you've handled the part of the exam that separates the candidates who pass from the ones who have to come back. You've got this. If this video helped your preparation, take a second to like it and subscribe, so the next person studying for their Michigan license can find it too, and so you'll have it ready when you come back to review before test day.